Well, welcome everybody to the Middle Class Investor. This is Seth Martin, your host. It is Sunday, November 11th, and got a chart of the S&P 500 index up. And as you can see right here, we had an up week, and we actually went into this space that I drew here. Of course, I drew it further out, like a week or two out. And it still could be a week or two. I mean, it could come down and then come back up here. But it doesn't have to. So I want you to know that this pattern is complete. If you look at this, 1, 2, 3, 4 weeks down, 2 weeks up, that's about right. That's about the minimum time that we would expect the market to correct a trend. Now, I still think this is the top, okay? I'm operating as if this is the top. But I'm going to tell you, what was it, Thursday last week, or maybe Wednesday last week, the internals were very, very strong. And usually that doesn't happen. I mean, you can still get a lot of price movement. A lot of times people think, oh, well, the market's really strong, and they're just looking at price. But the market can move a lot even when the internals aren't strong, because the rush to bounce is pretty high. But the breadth and things like that, the width, the breadth of the market and how the market responds internally, a lot of times those internals are not strong. So, I'm operating with this being the high, but and this being some sort of correction into the high at the 61.8% retracement. But I will note that I think it was on Tuesday or Wednesday, the internals were really strong. And, it's possible that this is somehow extending and there's going to be something more complex to the upside. I don't think so. One of the reasons I don't think so is because if you look at, and I know some of you don't understand Elliott Wave and don't even care about it, but one of the things I use the reason I use it is because it gives me some idea about where I am in the trend, or if the trend's potentially changed. And anytime you have 5 waves, so 1, 2, 3, 4, 5, we've got 5 waves in the direction. I mean, this could be just A, okay, and we got a B up and then a C down. But likely, when you see 5 waves in some direction, this is telling you that the trend is potentially changing. So if you look at the way I've switched to a daily chart, that's why this looks different. So what was this? This was Friday. This was Thursday, Wednesday. So Wednesday, we gapped up. I mean, there's this huge gap here, right here. So we gapped up and then ran up all day. I mean, that's huge, strong, and the internals were really strong. So, but then look what happened. I mean, we had an inside day, and then the following day, the market sold off pretty strong. Rallied a little bit, but that could just be, this could be like a 1-2 in here, and we've got 3 coming. So just, play the cards close to your vest. Be cautious. Think in terms of probability. Okay, that's what's likely to happen given that we've got 5 waves and we've got what could be a corrective move up. So let's look at that. Could this be a corrective move up? Does it show kind of what a corrected move up looks like? So let me just show you. This was kind of A to here, B here, and then C. So this could be a correction, okay? It does follow the rules for corrections. Doesn't mean it has to be, it just could be. All right. So let's look at the VIX. Let's go back to a weekly chart. So the VIX was down. Which you would expect with the market being up all week, the VIX would be down. If you look at the daily, the VIX was up later in the week and down early in the week. Let's look at the Dow Jones. The Dow Jones is a little bit stronger. The retrace is a little bit stronger. You can see that this is corrected more than 62%. And so this is another piece of evidence for potentially a new high. And this could just be that, marginally speaking, more and more, sellers are buying into more big cap just to protect their downside. It just remains to be seen. We'll have to wait and see. Okay, the short-term Treasury still moving up. We had a pretty good up week last week. The 10-year Treasury moving up, but pulled back last week slightly, not much, not even worth really mentioning. These other countries, Germany's still hanging around the lower bounds of this channel. So we've talked about what this means, the fact that it kind of broke through the channel but then broke back up into it. And you see that similarly with Japan. Japan's kind of leaning on the lower end of this channel and then went back up into it. The UK broke out more substantially, but then got right back in and is moving up. So it could just be this slight violation of the channel could just be the way I drew it. I mean, there's nothing magic about drawing these channels. You're just trying to get your eyes to see, the bounds of the price action, so that you can pick, help pick places to enter and exit. Okay. So let's look at, let's switch over to toss charts and look at, well, let's look at the ES first. I mean, you got a clear break of this channel, retest, and a little bit, so similar kind of what we're seeing in the foreign markets, except it's not happening in a downtrend. It's happening kind of as a break of the uptrend. So, that's interesting. I think for a trader, I would have been looking to get short like right here, because a lot of times everybody draws these trends. So what happens is, when the market kind of starts getting up here back to this number, you'll see that it'll sell off. And of course, we haven't done that yet. We actually broke back through. Again, I mentioned the internals on Wednesday, and it could be a function of that. It could just be, bull markets die hard. That's certainly true. We've certainly seen that. I mean, look at how choppy it's just been over the last, since 2018. We had this pretty strong run up here, but we had this sell-off and then immediate sell-off again. So it looks like, there's plenty of sellers in this 2900 area, 2870 area. All right, let's look at gold. Gold pulled back hard last week after breaking out. It's really just kind of pulling back to this consolidation line. But I do think gold is going to rally hard into the coming weeks and maybe a couple of months into this the 1300 area, 1320-ish. And then I would be looking to get a little bit more cautious on gold after that. Silver, you can have a similar situation with silver. It pulled up. It's pulled back to a higher low. If it makes a lower low, then obviously you got to get stopped out. But if it has an inside day here and then, or an inside week, and then starts to move higher from there, I think I would enter silver and look for it to maybe get up into at least into the 17 area, where overhead resistance starts rearing its ugly head. All right, the euro US dollar. What I'll say about this is, if you invert this chart, yeah, I can't do it. I thought I could do it here, but it looks like the US dollar. And what I will say about the US dollar is that there are a lot of bulls on the US dollar. So if there are a lot of bulls on the US dollar, there can't also be bulls on the euro. they're opposite of one another. So what I would say is that most of the time, the speculator class is wrong. They tend to be wrong at the turns, and if there's a record supply or a record number of bulls right now in the U.S. dollar, then I would say that's probably bearish for the dollar and bullish for the euro. So now, right here, you can take a position and immediately put a stop below this low right here. Let's look at this a little closer, because a lot of you wonder sometimes. I know, how do I trade this? What do I do? Well, here's the swing low. Okay, here's the low right here. So let's put a line there, and you can see we're basically at that low. So you could enter a position right here, a bullish position, go long, okay, and then put a stop in right here. Whoops. Just put a stop in right here below that low somewhere. It can be arbitrary, it can be some number of pips, it can be some percentage, whatever. But make sure you don't sell until you get below this low, because then that tells you this could go lower. And so we don't. Here's the thing. Maybe it goes to here, it stops, and then turns around and goes up. But we don't know that. It could go here, test the underside of this area here, and then go much lower. So you really don't know. So you gotta kind of set your stops. What we do know is if it breaks this low, then it could be this was just a correction and a continuation move. So the trend is down. We've got a little correction here, and now it's continuing lower. So you want to be real careful when you enter these positions this close, because there's the old saying, it's hard to catch a falling knife. Well, this knife is falling, and maybe it's done. We don't know. Maybe it's done. But we just want to guard ourselves against the risk of it not being done. And so you want to put your stop just below this low here. Okay? All right. Let's look at the British pound. British pound, I like the British pound here. I liked it actually back in here, but then once it got, I don't know, somewhere in here, it got too far away. I didn't want to chase it. But we've had a good pullback in the British pound. We might have a little bit more to go, but I like this British pound. There's a lot of talk about the Brexit. They're having problems with negotiating with the Europeans, and I don't know. To me, it's just a good reward to risk here. At least trading back up in here to this 1.45 area. Of course, if the dollar does go much higher, that's going to have a negative impact on the British pound. So just keep your ear to the ground on the U.S. dollar and see where that's going to go. See where that goes in the coming days and weeks. And then, trade these other pairs accordingly if you're going to. Now, oil, we had this, I don't know when we put this box up here, some time ago, but it was just I think initially we had a box off of this pivot right here, and we moved it up as we made higher highs here. So as we made this high, we moved it higher. As we made this high, we moved it higher. And anyway, we left it here last, but you can see oil has sold off sharply since kind of getting into that $70 area, $75 area, and I mean it's just going straight down. So it's pretty close. I mean, there's some stopping points here, like right here, potential stopping point, and there's another potential stopping point right here. And so I would say that those are both good potential stopping points, because likely what you're going to have here is you're going to have something like this, where it's going to kind of go A, B, and then C down to this lower level. I think we're in some sort of sideways consolidation. So I would look for oil. The sell-off in oil is just about done. Maybe has another 3 or 4% to go. Certainly you can trade that if you're trading a very short-term chart, but I wouldn't get short here with any long-term because what's going to happen, you're going to trade it down to here, but it's going to go a little further, and then it's going to bounce, and you're going to feel like you're going to feel a lot of pressure to buy that back. So I would just wait for the bounce and then kind of do a bull flag. A bull flag is like, well, let me zoom in. I'll show you what a bull flag is. So see how the trend is up? You got a low, you got a high, you got a higher low, right? And let's say you want to get in, you want to get engaged with this trend, but you don't want to chase it. You want to just get into a place that has a good reward to risk, and you know, that kind of deal. Well, you can put in a little channel or a flag, and the idea is, you know, the market moves up, it consolidates in the flag, and when it breaks out, and you could do it here, you could do it on the pullback. So it broke out and then it pulled back. You could enter here or here. It doesn't matter as long as you put a stop below this low here. Okay, so you know it breaks out, pulls back, and then it's off to the races, right? This is called a flag. And the idea is you know, normally it's the flag is at half staff, right? So you got pole, flag, and then pole maybe up to here. But what do we know? What do we know about the first move off of an important low and then the first pullback? Well, what we know, let me use the Fibonacci tool. What we know is that that's usually a, you know, it can go as high as a 1.67 move, right? So here's your 1.6 move, and another thing that got him Dave Johnson uses. Let me show you that one. Let me erase this one, because one of the things you see, you got a pullback here, and then you got a breakout right here, right? Okay, so there's a breakout right here. So this move right here, there's a trading tendency that people follow, where you capture 200% of the move. So you go to the high and pull back to the low, and the idea is at 200% that's your target. So right in here's your target. And the idea is once something breaks out from an old high, it usually goes about twice as far before it stops. Now you can see this went much further. So let me go back to what I was originally saying. If you have an important low and you have a move off that low, then you want to target. You can use these Fibonacci's, and you should play with this if you like this technique. But you can go to the high, pull back to the low, and you can extend where the price action might go. In my experience, is it usually goes somewhere between, just like it does here, somewhere between 1.61 and 2.61. So depending on how aggressive you want to be, now this is always just off the first move, okay? After the first move, after the first pullback, off the first move, okay? You can go for the 2.61. If it's in the middle of the trend, this doesn't hold, okay? Don't use this if it's in the middle of the trend. Only use this on important lows and highs. It works on highs and lows. In fact, let's go back to the British pound. Let's just take a look at this. Let's zoom in on this. Okay, so we have this, no doubt, is an important low, right? So off this pivot, this low right here. Let's zoom in. Now, so this looks like the first move up. This is the first pullback. So I'm going to go from high to low here with the Fibonacci tool. This is a great tool. You ought to get in the habit of using it. Go to the high and pull back to the low and click. Look where the market went. 2.61. This number right here. This happens all the time. All the time. So learn how to use this tool. Look for these important lows. Look for a pullback and then a breakout off this, a higher low. So we have a low. We have a low right here. Hopefully you can see that. And then we have a higher low. So we have a low, a high, a higher low. What is that? The beginnings of a trend, right? Beginnings of a trend. So somewhere in here, you want to be a buyer, and so your risk is what? Your risk is right here. Your risk is here. You sell below here. So this is your risk. Okay. So that's your risk. And then your reward, you make a line here at the 2.6 area. Now, you wouldn't have all this price action to see, but you could make a line here at the 2.6 area, and you could go a little less. That's what I do. And then this area right here is your reward. Now, if you did only this, if you only look for this setup, you can make a lot of money. Okay, because basically what's going to happen is you're going to lose $300 here, but you're going to make $3,000 here, or maybe not $3,000, but you're going to make $1,500. So that's probably a 5-to-1. I can probably fit 5 of these inside of this area right here. Okay, 5-to-1. I mean, you're going to be wrong maybe 50-60% of the time, but on the times where you're right, you're going to make a lot of money. So this is a good technique. You'll see this show up over and over and over and over again in all different kinds of markets. It doesn't matter which market you try. In fact, the big problem with that technique is, like on this low here, you don't really see. I mean, it ran pretty good ways before it pulled back. So if I do that here when it runs a pretty good ways, sometimes you got to back off that rule. But if it goes up and then immediately back down, but a higher low, it's a good technique. So let's just see what this one does. If you try to go from here back to here, you can see that the 2.61 is probably much higher, probably outside. Yeah, well, it still went that far. See here, 2.61. So, but you probably would have, if you're a normal person, you know, all this choppiness here and then this pullback probably would have shaken you out for maybe break even. But that's the thing. It's why you should go test these little rules yourself, because what you need to do is develop confidence in them. And once you have confidence in them, you'll stay through all this. You'll set your stop down below this pivot low right here. And then as it comes up and it makes a higher low and then takes off again, you'll set your stop below this pivot low, and so on and so forth. But again, if you follow that same logic, you know, set your pivot low here, you would have gotten stopped out right here, which is about break even. So you got to really stick to it when you're doing this Fibonacci extension target technique. Because it's easy to get shaken out. I mean, you start thinking about, oh, I had a gain and now I lost. And again, it's that psychology we've talked about before on here. All right, one thing I want to show you, and first of all, what I want to say is that it's really difficult to predict the market. Okay, prediction is not what trading and investing is about. What trading and investing is about is looking at the weight of evidence and going with probabilities. Okay, what's probable given this, and this? Okay, that's what trading and investing is about. I want to be very clear about that before I show you these next charts. These next charts, people are going to go, oh, well, that's getting predict the market, and it's gonna confuse people, and I don't want you to get confused. But what Robert Proctor, his work is I think very important, and especially if you want to get an idea of what the longer term prospects of the economy and the market are, you can use his work to help you glean some insight from that. So this is from the Elliott Wave Theorist here in November. And I just want to point out we're looking at 3 charts here. We're looking at the crash of 1929, crash of 1987, and then we're looking at a crash setup here in 2018. So what I want to do is I want to zoom in on these charts, and I want you to try to get a sense for how similar they are. So forget about the numbers, the count, okay? Let's just look at the move. Okay, so we got this move down, okay? We got this rapid move back up, and then a crash, okay? I think over 5 days it went down 33% or 34%, something like that. Same thing here in 87. You had this move down. This was a flat. So here this was not a flat. It was an ABC. It was just a simple zigzag. Remember how we were looking at the number of bars down And then we looked at the ABC, and I said it had gone far enough. Look how short this zigzag was to this 2 in 1929. Now this one was a little longer, right? It first of all, it was a flat. Because B fell below at 1, so that makes it a flat. And then it rallied up. But look here, another crash, like 25% in just a few days. Okay. So what do we have here? We've got something that looks very similar to this one over here. We've got a move down. We've got a correction that looks very similar to this one. And look where we are. We're at the 62%. So we're at 62%. Draw that right. It's actually 61.8. But let's just round up to 62%. Now, the psychology behind it, the magic about this number, the reason this number turns up so often is because what was happening last month when everybody was calling this a pullback, right? A pullback. So when there's a pullback, people take extra money and they jump in because they think, and a lot of times you're right. Okay, you're right. But this is why it's important to be able to count the waves. Because if it's a pullback in a 3, then yes, it's just a pullback. But if it's a pullback in a 5 waves, then it's potentially a bear trap. Okay. But the reason the 62% is important is because many of the feelings that people had right when we're here in the market were very similar to the feelings that people had here. And this investing and trading in the market for the masses is an emotional. It's very emotional. So whatever they were feeling here, they're also feeling again here. So what tends to happen is people all along the way, more and more people are jumping on this trend because they think, oh yeah, that's the bottom. That's the bottom. I'm getting on. Everybody's getting on. And then you have a break, and then there were no sellers anywhere in here. I mean, there's no negative outlook anywhere on the market. You get kind of this crash situation. So just be aware of it. It doesn't mean it's going to happen. This could trickle its way on up higher. Okay. We've had a pretty deep retracement, deeper than what we had in 87 and in 1929. But the market doesn't necessarily repeat itself, but it does tend to rhyme, and it rhymes in this particular form. This 5 down, 3 up, or if it's a bull market, 5 up, 3 down, so on and so forth. But one of the ways for example, in this one especially, one of the ways you knew that this wasn't a pullback is it moved down in 5 waves and it ran up in 3. So maybe right in here, you should have known that this was not a new bull market. You could have got out right here. Okay, I'm not saying you could have got out here, but you could have got out right in here, because once this pulled back, and even then you could say, well, this was a lower low, so maybe I shouldn't even have been in until right here. But once it rolled over and started pulling back, you're getting out right in here. So this was a little bit more tricky because the B was very sharp, but it was very short. And I think in general, if you look at, there's fewer days in this move than there is in the 1929 move. But that's just because it's probably the first of many, whereas this one right here was probably the first of this one. In other words, we're a whole cycle degree. This is super cycle and this is cycle. So we're a whole degree of trend higher here. So you have to kind of take that into account. So that's another great point, though. However long this lasted, this is going to last, could last anywhere from 2 to 5 times longer than this lasted. So you just you don't have to believe in this. I mean, I've seen enough of it to believe in it myself. Is it still wrong? Yeah, occasionally it is wrong. Okay, no doubt about it. I'll say this very emphatically. There are no models for the market that work 100% of the time. For one thing, it's hard to even measure that because people tend to bring their own biases to the market. So it may be that Prechter has a negative bias to the market. And we don't know that because he doesn't share it with us, but it could be that his negative bias is finding these relationships. And that does happen. I mean, that happens a lot. So you just have to be aware of it. What I like about the model, though, is it gives us, and the best way to explain this is just to maybe go back and show you the, go back and show you, and I've showed you this before, but just go back and let's look at the all data. Let's close that so I can get plenty of data here on the chart. And let's go to the S&P 500 index. And let's put it on log. And let's just look at, here, let me zoom in and get rid of these lines here. It's not so hard to see what's going on here. I'm going to leave the channels because I think those are important to keep on there. All right. So let me, so going back to 1929, again, this move right here was cycle degree. Let's just see how long it lasted. Just for grins and giggles, it lasted from here. Let's make this days. So I'm going to see how many days it lasted. Yeah, see the chart look different because this is the day. The data is only days. It's not intraday data. Okay, so it lasted 983 days, about almost 3 years. So we could have a situation where, you know, the next one lasts more like, it could last 3 years or it could last 6 years, let's say. But so you had this pullback, and I think, me personally, I clearly see 1, 2, 3. This is all 3. Because see here, you can see a 1, 2, 3, 4. Right here, 4 with this consolidation, this triangle. 5, and we had kind of an extended 5 that lasted from 1975 all the way to up to 2000. And then we had the big bear market top in 2000 that was supposed to, you know, due to the dot-com bust. We had the run-up during George Bush, and then the fall. It started under George Bush that lasted under Barack Obama. So basically, this whole thing is a 4. And then that would make this 5. So you can, to me, you can easily see 5 waves, and that tells you. Again, I've studied the model enough to know that tells me that I need to be out of this deal because we're coming back to here at least coming back to here. Well, in the S&P 500, that's 500 points. I mean, am I interested in losing in my 401k down from 2780 down to 500? No. I mean, that's a 90% loss. And that's something else I want to show you. I'm just going to show you real quick. If I go from high to low, right there, that change is. Hold on a second. How come that's not looking right? Oh, well, that's not the low. That's why. But if I go from high to low, right there. Well, let's do this. Let me. Sorry, I'm changing what I want to do. Let me go from high to pivot to the pivot area, okay, that I have on the chart. So from high to the top of the pivot area, right here, to the very top of the pivot area, is minus 79%. Let's say we go to the middle of the pivot area. That's minus 82%. Let's say we go to the bottom of the pivot area. That's minus 84%. Okay? Let's say we went all the way back to the, well, I can't do it here from the chart, but if you go back to the 87 lows, or excuse me, yeah, the 1987 lows from that crash, that pivot area is right here. So let's just do that real quick. Remember how we talked about how the market, it doesn't necessarily repeat itself, but it rhymes. Okay, so let's go back to that other pivot area low, which is down here, right here, and that is almost 93%. 93%. So, I was once talking to somebody and they said, well, I just have a all in all the time strategy. And I said, okay. And their comment to me was, if the market pulls back like that, I'm just going to buy more. I said, okay, but and maybe you have extra money to buy more at the bottom. Okay. But then it takes a lot of guts to do that. Right. But let's say you did that, or your plan was to do that. Well, you'd have to have more money by the time we got to the bottom. And most people in their 401ks, they're just all in all the time. So that they're not going to have any more money. Maybe some of you listening will, but the vast majority of people are not going to have any more money if we go minus 90%. Okay. And I know that sounds unrealistic and impossible, but you just need to understand the market can do anything. People are going to be shocked at what the market does the next time we have a big sell-off. They're going to be absolutely shocked. And they're going to lose all faith in markets. There's going to be all kinds of ramifications from a big sell-off, like we don't believe in capitalism anymore, markets don't work, we need the government to do something. I mean, these are all going to be negative things that are going to happen. But the best position you can be in is in a position with money and an opportunity to take advantage of, multi-generation low prices. And that's kind of that's what this is all about. So hopefully you're getting that. Hopefully you feel that. And we'll keep coming in here and talking about it. But I wanted to mention that timing of potentially this actually crashing, in case you were holding out for higher prices here. And if you are holding out for higher prices, that's fine. But if this rolls over in a big way, especially if it takes out the old low, man, just get off those train tracks, let the train come on by. I think that's the best bet. Certainly it's your money. You can decide what you want to do with your money. But I am the one here making the videos. I'm trying to help to the extent you're willing to take the help. Take it. If you just don't know, or if you just don't get stuck in the psychology loop that we've talked about many times on the program here. Okay? All right, everybody. Thanks for coming in this week. It was great talking to you. We got the holidays coming up. It's going to be a great time. A lot to be thankful for. We got Thanksgiving coming up toward the end of the month, and then Christmas next month. And oh my gosh, I can't believe it. 2019 just around the corner. I don't know. It just doesn't seem that long ago that I was in high school, college, that kind of thing. So, all right, everybody. Thanks for coming in. We'll see you next week. Bye-bye.